Are you ready to maximize your returns on real estate investing? One of the most important factors that determine your success is understanding rental yield, a simple yet powerful metric to evaluate a property's earning potential. In today's video, we'll break down the concept of rental yield, teach you how to calculate it step by step, and share tips to ensure your investments are bringing you maximum returns. So, if you're looking to make smarter real estate decisions, this video is a must watch. Welcome back to Wealth Raah, your go to channel for smart financial advice and strategies. If you're new here, don't forget to hit subscribe and join our community of wealth builders. Let's dive straight in. What is rental yield? Rental yield is essentially the return on your real estate investment based on the rental income it generates. Think of it as a measure of how well your property is performing financially. It's a quick way to determine if a property is worth investing in or not. Let's break it down with a simple example. Imagine you buy a property for Rs 50 lakhs and it generates $20,000 per month in rental income. That's Rs 2.4 lakhs annually. But is that a good return? That's where rental yield comes in. Types of rental yield. Before we calculate, it's important to know there are two types of rental yield. One, gross rental yield. This is the basic calculation that doesn't account for any expenses. It's calculated as annual rent, property value, x 100, to net rental yield. This is more accurate because it accounts for expenses like maintenance, property taxes, and repairs. The formula is annual rent, expenses, property value, x 100. While gross rental yield gives you a quick overview, net rental yield provides a clearer picture of your actual returns. Step-by-step calculation. Let's calculate gross rental yield first. Determine annual rent. If you're earning $20,000 per month, multiply that by 12. Annual rent, Rs 2.4 lakhs. Find property value. Let's say the property is worth Rs 50 lakhs. Apply the formula, gross rental yield, Rs 2.4 lakhs, Rs 50 lakhs, x 100, 4.8%. Now let's move to net rental yield. Assume you spend Rs 40,000 annually on maintenance and taxes. Subtract expenses from annual rent. R 2.4 lakhs, R 40,000, R 2 lakhs. Apply the formula, net rental yield. R 2 lakhs, R 50 lakhs, x 100, 4%. This 4% is your true return after accounting for expenses. What's a good rental yield? Now you're probably wondering, what qualifies as a good rental yield? In India, a gross rental yield of 2 to 5% is common for residential properties, especially in metro cities. For commercial properties, yields can range from 6 to 9% or higher. Higher rental yields are generally better, but it's important to balance them with other factors like property appreciation, location, and overall demand. Tips to maximize rental yield. Choose the right location. Properties near offices, schools, or metro stations tend to have higher rental demand and better yields. 2. Focus on affordability. Mid-range properties often attract more tenants compared to luxury properties, improving your occupancy rates. 3. Minimize expenses. Regular maintenance can prevent costly repairs in the future. Also, negotiate property taxes and other charges wherever possible. 4. Diversify your portfolio. Don't put all your money into one type of property. Consider mixing residential and commercial investments for steady returns. 5. Regularly review rent. Analyze market trends and adjust your rent accordingly. Stagnant rents can eat into your returns over time. Bonus, the role of appreciation. While rental yield focuses on income, don't forget about property appreciation. A property with a slightly lower rental yield but higher potential for appreciation might still be a great investment in the long run. For example, an area with upcoming infrastructure projects, like a new metro line, might offer lower yields initially, but the property value could skyrocket in a few years. Always consider the bigger picture. Let's recap. Rental yield is a crucial metric for evaluating real estate investments. Here's a quick summary. Gross rental yield gives you a general idea, while net rental yield provides a clearer picture by accounting for expenses. Calculate yield using the simple formulas we discussed. Aim for higher yields but balance them with other factors like location and long-term appreciation. Follow our tips to maximize returns and make informed investment decisions. If you're serious about building wealth through real estate, understanding rental yield is non-negotiable. What's next? In our next video, we'll explore the top tools and platforms you can use to analyze real estate markets in India. From Magic Bricks to Prop Tiger, we'll show you how to leverage technology to find the best investment opportunities. If you found this video helpful, give it a thumbs up and subscribe to Raah for more actionable financial tips. Drop your questions about real estate in the comments below. I'd love to answer them in a future video. Until next time, Dostan, keep building your wealth Raah to financial freedom.